Welcome to NovaDigest, where today's complex global events become clear, balanced, and engaging. We break down the noise to deliver sharp insights that inform without overwhelm, so you stay ahead without burning out. Subscribe and transform how you understand the world. Today's news is about the Australian dollars, AUD. Recent rebound after a 3-day decline against the US dollar, USD, has been framed as a market response to conciliatory trade rhetoric from former US President Donald Trump in anticipation of a high-level meeting in China. But this interpretation masks deeper vulnerabilities and structural forces driving odd volatility, forces that are far more complex than political soundbites or diplomatic optimism. Beyond the headlines, what really moves the odd? The conventional explanation attributes the odd's rebound to Trump's remarks hinting at a more open stance on trade. However, this narrative ignores the empirical disconnect between political rhetoric and sustained currency movements. Multiple studies, including research from the Bank for International Settlements and the Reserve Bank of Australia, confirm that the odd's fluctuations are more closely tied to commodity prices, particularly iron ore, than to geopolitical statements without policy substance. Indeed, the odd's recent recovery occurred in parallel with a reversal in iron ore futures, which had previously fallen by 4%. This market dynamic suggests that the rebound was more a function of commodity corrections than diplomatic recalibration. China's meetings, overhyped and underexplained. While the media ties odd volatility to an impending high-level meeting in China, the opacity of Chinese policymaking challenges this assumption. Historical patterns and leaked deliberations indicate that China's internal economic agenda, particularly stimulus strategies and domestic supply chain issues, often eclipses bilateral concerns with Australia. Furthermore, tracking of Chinese state narratives reveals a shift from trade diplomacy toward security and strategic autonomy, limiting the relevance of these meetings to Australian exporters. The odd sensitivity to such opaque events should raise caution, not confidence. Speculative volatility versus market sentiment. Market mechanics also play a significant role in distorting perceived optimism. More than 60% of Australian dollar to US dollar trades are algorithmically executed, with price swings often amplified during low liquidity periods such as the Asian trading window. High-frequency trading and short covering frequently create false trend signals, misleading observers into interpreting speculative noise as genuine investor confidence. This structural distortion underscores the need to separate trading momentum from macroeconomic fundamentals when analyzing currency movements. Systemic risk and stakeholder power asymmetry. The odd serves as a regional risk proxy, its movement shaped less by Australia's actions and more by external power dynamics. The US, as the issuer of the dominant reserve currency, wields disproportionate influence over global trade narratives. Meanwhile, China's economic policy shifts, often veiled and unilateral, hold significant sway over Australia's export-led growth model. Australia's limited ability to influence either actor leaves its economy exposed to indirect consequences of broader geopolitical negotiations. Despite the optics of stability, the odd's recent rally is a tactical pause, not a structural recovery. Critical thinking for market participants. To make sense of these dynamics, traders and policymakers alike should cross-reference odd movements with real-time commodity pricing, for example, iron ore futures, rather than relying solely on political commentary. Analyze ASX trading volume data to detect high-frequency activity and short-term positioning. Monitor China's internal policy statements and fiscal signals, particularly around stimulus or supply chain adjustments. Actionable takeaways. Don't mistake noise for signal. Political rhetoric rarely drives sustained FX trends without policy follow-through. Follow fundamentals. Iron ore, coal, and LNG prices offer more predictive insight into the odd than headline diplomacy. Diversify dependencies. Australia must reduce reliance on Chinese demand and expand trade with India, Southeast Asia, and Africa to mitigate asymmetric shocks. Enhance market transparency. Increased reporting on algorithmic trades and foreign lobbying would help illuminate the forces shaping market perceptions. Conclusion: stability is narrative, not reality. The odd's rebound should be seen not as a vote of confidence in global trade diplomacy but as a reminder of Australia's structural exposure to external shocks. The volatility reflects a broader pattern where financial markets react to surface-level cues while deeper geopolitical and economic imbalances remain unaddressed. For investors, policymakers, and auditors alike, the lesson is clear: interrogate narratives, validate with data, and remain skeptical of stability claims that serve the interests of dominant stakeholders while obscuring systemic fragilities. If clarity matters to you, stay with NovaDigest. Subscribe, share, and explore insights that go beyond the headlines, smart, balanced, and made for minds that question more.